All right, it looks like it is noon, and we're going to kick it off. Ed, Terry, I don't know if you can hear me. If you can just give me a confirmation, that would be great.
Hi, it's Ed Kerschner. I'm hearing you loud and clear.
This is Terry Pederiti. I'm good to go as well.
All righty. Well, it looks like we've got plenty of callers that have tuned in. Terry, I'm going to hand it off to you. But if you are on the line right now, thanks for joining us. Make sure you stick around at the end as well, because we're going to go through a Q&A session. But without further ado, Terry, you wanna hand it off?
Absolutely. And Jordan, Deanna, Warren, Krista, the entire group, thank you so much for allowing us to spend the next 20 to 30 minutes with you today. It's certainly a very interesting time that we are all coming to with all that is going on in the geopolitical events in the marketplace, as well as the inflation and interest rate conversations that are going on. I've had the privilege and opportunity to work with this group for the better part of the last 20 years, 10 of them now representing Columbia Threadneedle Investments. And Columbia Threadneedle Investments is a $750 billion global asset manager with 17 offices around the globe. They can really provide perspective in a lot of different areas of the market. Within that $750 billion, about half of that is retail money. The other half is institutionally managed. And then within those areas, about half of that is in the equity market and half of that is in the debt market. So a lot of different areas we can certainly touch on today. And one of the best things about Columbia is the intellectual capital and resources we can bring to the table. And that allows me to have the privilege of introducing Ed Kerschner to you today. Ed is our chief portfolio strategist. He came to Columbia in 2013. Ed brings over 40 years of investment experience, holding a variety of chief investment officer roles throughout his career, firms such as Citigroup and Payne Weber. He also teaches graduate level finance at NYU. And we've asked Ed to come here today and provide a little bit of perspective, maybe some historical viewpoints on the market, where we are at, and then most importantly, to answer any questions that the group has for Ed. So with that being said, again, I will thank Deanna, Warren, Jordan, and the entire team for allowing us the opportunity to speak with you today. And I will turn it over to Ed Kerschner.
Thanks, Terry. Good afternoon, everybody. Just afternoon. I'm going to tell you very little opinion today. I'm actually a mathematician by training. I believe in using data, and I think the data is easier to understand than opinion, which tends to change very often. So let's just do a little quick history where we're coming from. Being a math geek, 2020 was a pretty easy year. It was a scary year, but it was easy. All you had to know was one thing: we weren't going into depression. I remember there was a great degree of fear then, but if you looked at what was being done, the Fed cutting rates to zero, the government putting through a huge stimulus plan, running deficit around 25% of GDP, money supply soaring. It was clear, if you put that into any econometric model, we were going to have a sharp V-shaped recovery. So as scared as you were, you had to get into the stock market. 2021 was also relatively simple, at least from a data perspective. It was another variable, it was earnings. We began the year with consensus was earnings would be up about 10 to 20%. By June, consensus in 2021 was earnings for the S&P would be up about 30 to 40%, and we ended the year with earnings up 50%. So the market kept stepping higher as earnings kept going higher and the value of stocks therefore went higher. So 2020, 21, it was pretty simple. Look at some data and you had to be bullish on the stock market. As we began 2022, it wasn't quite so simple. growth was expected to slow in the economy, what we call GDP. Earnings growth expected to be single digit, not 50, not 20, not even 10. The government was done with stimulus. The economy was growing. I know there still is a campaign to do build back better. I'm not making a political statement, but it's $1 trillion spread over 10 years. It's a very small amount of economic stimulus. And as you're listening to the news today, Chairman Powell is telling us they're going to raise interest rates beginning this month. So we don't have the interest rate support. We don't have the government spending support. And the market looked, as we began the year, at least fully valued. If you did the math and you adjusted for the fact that bond yields were still, by historical standards, relatively low. I'm sure some of you remember when interest rates were 10 or 15% and they were just 2%. But the market had, if I did the math, about a 5 to 10% downside. Inflation was high. It was going to probably stay high for a while. And I'm going to go into a little detail there. And therefore, the bond market was not a great place to be. I think, as you know, if interest rates go higher, bond prices go lower. And stock market returns are going to be limited by what were, by historical standards, unprecedentedly high valuations, slowing economic growth, modest earnings growth. And as interest rates go up, the price you pay for the stock market, what we call the P ratio, goes down. Where are we now? Well, the market looks roughly fully valued. Looking at the 10-year Treasury bond at 1.75%, looking at the market trading at around 22 times trailing earnings, 19 times next year's expected earnings, adjusted for current interest rates, the market actually is, within 2% of where it belongs. Technically, it's 2% undervalued our model. Don't you overuse models. I've never in my 45 years in both academia and on Wall Street found a model that's good with even 5%, let alone 2%. So what are we worried about today? Well, there's actually only two things investors ever really worry about. And it reminds me of a poem, I think it's by Robert Frost, called Fire and Ice. I don't know how the world will end, fire or ice, but either one will suffice. And ice, well, the investment equivalent, that's depression, that's recession. Economy goes down, earnings go down, stocks have less value. If they have less earnings, they go down. Fire is inflation. Inflation takes off, interest rates go higher, the value of stocks is lower because you're competing with higher yielding bonds. So the question is, fire or ice, what's the risk? And as we began this year, no one was asking me, Ed, how bad is the recession going to be this year? No one's looking for recession. Indeed, there's no model we see that would predict inflation, a recession this year. The question I get is, inflation's terrible. Is it going to ever get better? Well, the answer inevitably is yes. The question is, why is inflation so high today? Well, I'm going to share with you 4 numbers so you get a handle on what inflation is. I think most of you have heard of the Consumer Price Index. The latest data says it's 7.5%. There's also consumer surveys. What do you think inflation is going to be? And over the next year, consumers expect inflation to be just under 5%. I don't pay a lot of attention to where we've been, that's CPI. And frankly, I don't pay a lot of attention to what consumers expect. They tend to expect where we are today, give or take. Do you know that there's actually a financial instrument that trades on where inflation will be? Has a fancy name. It's called the 5-year forward inflation expectation rate. It's not a survey of what do you think. It's not where you've been. It's put down your money, and if you're right, you make it. If you're wrong, you lose. The 5-year forwards are trading at an inflation rate of 2.1%. The best model I know for forecasting inflation over the next 10 years comes out of the Cleveland Fed. Their forecast is 1.9%. I've seen a period like this recently. So have you. You might not realize it. Go back to the global financial crisis, 2008. CPI was running around 6%. So you know what consumers thought inflation was going to be? Around 6%. Interestingly, the actual market where you invest, the 5-year forwards, never got above 1.5%, and the Cleveland Fed model never got above 1.5% either. So we had transitory inflation then, and indeed, unless you think inflation stays at 7.5%, we have transitory inflation now. I don't know why the Fed stopped using that word transitory. So why is inflation here at these transitory levels? Well, let's dissect inflation. 7.5%. The single biggest contribution to inflation is the cost of transportation. Of 7.5%, 3.2% is transportation. And that's happening for two reasons. One, it's a fancy word, it's called base effect. Remember, we're looking at year-over-year inflation. So we're comparing prices today to a year ago. Well, do you know that for 11 months in 2020 into early 21, the cost of transport went down? Yeah, gas prices were down. No one was driving in April of 2020. Airline prices were down. So what you're comparing to is artificially depressed year-over-year comparisons. Prior to 2020, transportation never went up or down more than about 1/4 to 0.5%. The other issue is there is a supply chain bottleneck, and therefore there's a shortage of many goods. You can't get cars because you can't get semiconductor chips. But already that shows signs of ameliorating. We're seeing the cost of shipping goods already down 20% from their peak. Now, one of the key issues that leads to the higher cost of shipping goods and the higher cost of many things is there's a shortage of workers. In fact, we look at the number of workers looking for a job per job opening. At the peak of the pandemic in 2020, there were about 5 workers for every open job. At the peak of the global financial crisis in 2008, there were about 6.5 workers for every open job. Today, 0.65 workers per open job. That is less than a worker per job. Why is this happening? Well, one is being called structural. What is being called the Great Resignation. 3.5 million older workers have permanently left the workforce. I would put the word permanently in quotes if I might. It's transitory. Are 65-year-olds really going to stay retired? I'm 69. I've actually tried to retire 3 times. The longest I lasted was 7 months. Couldn't play golf 3 times a day. I stink. I don't want to sit home and watch Law and Order reruns. I'm happily married to my wife, Maxine, for 45 years now, but neither she nor I wanted to be together 365 days of the year, 24 hours a day. So I came back. I think many of those who are in the Great Resignation will come back. If you're 65, you got another 20 plus years of life expectancy. Doing nothing isn't necessarily fulfilling. A lot of us get pleasure from what we do, or we'll do something similar to what we do, or we'll do something totally different just to do something. We'll see, the return to the greeter at Walmart who's happy just to say hello and give you a card. I'm not saying the entire Great Resignation disappears, but I think it's largely a COVID phenomenon, which is the other part of the labor shortage. Workers who are scared to go back to work or can't go back to work because of COVID, and they have to provide childcare, which is very difficult to find, or some teaching education has still been remote. With, as you know, COVID now at trough levels, thank God the pandemic seems to have gone away. We're seeing return to the workforce, and therefore this disruption in labor looks to be at its trough and should be improving. So I would argue, to conclude on inflation, it returns to normal, which raises a definitional question. What's normal? Let me share again some data with you. Since 1750, inflation in the U.S. has averaged 1.6%, just over 1.5%. And every spike in inflation corresponded to war. Revolutionary War, 1812, Civil War, World War I, World War II, Vietnam. Not surprisingly, the Ukrainian conflict is having some impact today, principally on the cost of energy. Well, what will solve the energy problem? One is the economy will slow globally. We'll use less energy. Two, we have higher prices. So let's assume, I don't believe it necessarily is true, oil stays at $100 a barrel. If a year from now oil is $100 a barrel, how much is energy inflation year over year? Zero. So indeed, the reason we're having an energy problem, and we were having it before Russia, and it was largely a Europe problem. It wasn't an American problem. Europe, and it's not a political statement, it's a fact, they went green too soon. They closed coal plants. They closed nuclear plants. And it's been a bad winter in the North Sea. The turbines aren't turning much. There have been petrol lines in England 3 months ago. So indeed, this dependence on green energy turned out to be premature. This is not a reaction to the price of oil in the last week. So what about the Ukrainian conflict? Well, it's somewhat reminiscent maybe of, I think a lot of you will remember, there's the Cuban Missile Crisis. It was 12 days back in 1962, and the market fell 7%. But the market had already begun quite a correction. What had happened was the market, like it was early this year, was expensive. Growth stocks were very expensive. I'm quoting from a Wall Street Journal article back then. Stocks in 1961 had risen 27%, with leading technology stocks like Texas Instruments and Polaroid trading at price earnings multiples of about 115. That's the meme stocks, I guess, and the .com stocks and the cloud stocks of today. Well, we've had a nice correction in the market, about 10%. We've had a much bigger correction in the technology market. Ukraine, is it a permanent situation? Well, that's a political question. But let's remember, Russia is just 3% of global GDP. It's a rounding error. California is a bigger economy. Politically, this matters. Economically, it does not. And this, too, I think, will pass, hopefully successfully, like the Cuban Missile Crisis. So let's just talk about where we want to invest, and I will wrap up. The stock market, as I said, looks relatively fairly valued, unless rates really surge here, or if we enter recession in 23 and we'll have to be looking at data, and there are really good models that we use to forecast that. Right now, the probability of recession in 23 is 9%, which is nil. But if indeed the Fed raises rates too quickly and slows the economy too much, we could see recession. Conversely, if the Fed doesn't raise rates quick enough and inflation doesn't go away, we have interest rates pressuring the market. It's a tightrope the Fed always has to walk when they're trying to change policy, and we'll continue to look at models. But as of now, it looks like economy slows to trend about 2% next year, but not recession. Interest rates, I'll just simply say they're low. I think by historical standards, we all know that. The problem with low interest rates is twofold. One is you get paid very little interest when you invest in bonds. Two, if interest rates go up just a little bit when rates are very low, you actually end up losing money. For example, if you bought a 10-year U.S. Treasury bond that yielded 1.5% and rates went up by just 0.5%, your total return, including your interest income, is minus 1.7. If you bought the bond at 2%, which was the recent high, and rates were to go to 2.5, you didn't make 2%, you'll lose 1.1%. So the so-called riskless asset, the guaranteed U.S. Treasury, yes, they'll pay you your interest rate. If you hold it for 10 years, you'll get back your money, but in between, the price of your bond may go down. So you're going to need a more diversified portfolio than the safety of U.S. Treasury, what we call credit risk, investment-grade corporates, high-yield corporates, mortgage-backed securities, even international bonds. But all of those bonds look average attraction or actually a little bit below. So you're going to need to be very selective. Let me close with one last thought. We've essentially been through a 40-year bull market. Began in 80. Interest rates fell from 16% to 0.4%. The 10-year Treasury made you 8.5%. Your coupon plus a little price gain every year because the price went up as the yield went down. The stock market PE, price earnings ratio, went from 7 to 31. If I can give you an analogy, I was on vacation with my wife, Maxine. We were in the mountains, actually in the Rockies in the springtime. And one of the activities that they offered was downhill bicycling. They put a bunch of people into the back of a van, took us to the top of a mountain, and we downhill bicycled. I'm a really good downhill bicycler. 25 miles downhill, and we get into town. I say, Maxine, I'm doing the Tour de France. This is great. Look at me. Let's keep going. She goes, Ed, where are we going to go? Everywhere from here, it's uphill. Your Tour de France is over. Indeed, your Tour de France is over. You've been in essentially a 40-year bull market with occasional interruptions of 12 to 18 months. That doesn't mean we're going into a 40 or 10-year bear market. It means returns are going to be more normal. Our median return across all different investments, asset classes, 3.4%. And I know of no firm that has a number much higher. And therefore, you're not downhill bicycling if you simply buy the market. You buy ETFs like the S&P ETF, the Spiders, or the NASDAQ ETF, the QQQ, or the bond market has an ETF. It's called the AG. Simply being well diversified will not work anymore because you're not downhill bicycling. You're going to have to be very selective, whether it's the individual securities you buy or the fund that you buy. But actually, many fund managers are not paid to make money in the fund. They're paid to beat the index that they're compared to. If they're a growth fund, they have to beat the growth index. If they're a dividend fund, they have to beat a dividend index. They don't have to go up. So what you want is a very selective active mutual fund, or what we call a smart beta ETF. Simple diversification will not win, will not be adequate. You asked me, I think, guys, to do 20 minutes. I think I'm right on schedule. if you have any questions or discussion, I would certainly welcome it.
Well, Ed, that was some great insight. Yeah, I think you were right on that perfect timing mark. We've gotten a couple of questions ahead of time from clients, and also just based on what you said, I want to rattle off a couple of them. But I guess staying on the same theme that you just ended with, being selective, being strategic, making sure that you are allocating resources to places that are going to be more effective than just the broad indices. Outside of the S&P, because you touched on S&P fair value, whether we're talking about trailing or forward-looking PE, where are some areas outside of the S&P where you see relative discounts to history? And I'm opening up to any asset class, any sector, subsector, whatever you want to talk about.
That's a good question. I actually think the biggest opportunity is within the S&P. Often we look at what's called growth stocks versus value stocks. And actually, in November, growth stocks were trading at a 100% P premium to value, twice the value PE. The historical average is 36%. Almost as high as we got during the dot-com bubble in 99, 2000. And I know a lot of people said, you know, Ed, I know it's expensive. They said it's to me in 99, but I'll get out on the way down. Well, the way down was quick then and it was quick now. By year end, we were at 92%. And right now, we're at 69% premium. We're still expensive. And that's my point. So I would emphasize value strategies, like dividend income strategies, not the highest dividend. You know, if the yield seems too good to be true, it's usually too good to be true. But companies that have the fundamentals and financials to sustain dividends in difficult times and raise dividends when the opportunity presents. So dividend growth strategies would be one opportunity that we, within value, that looks relatively compelling. I think in the bond market, high yield has gotten expensive. What it's sometimes called junk bonds. Everyone was chasing the highest yield, and so they bought these bonds even as the yields went down when the price went up, and they got down to what we call the fourth percentile of attraction. That is, that they got, you know, you'd make money only 4% of the time. Well, right now they're a little bit better, but within junk, we're looking at what we call rising stars. They were 2020's fallen angels. You know, rating agencies downgraded a lot of companies in 2020 to junk. So one of our strategies is let's look for companies that will be upgraded from junk to investment grade, and therefore as their quality improves, they get a higher price. But what we found in our research is you have to buy them before the upgrade. By the time the ratings agencies upgrade them, you've made your money. Like, look at Netflix, for example, was downgraded to junk, about a few months ago, upgraded to investment grade. But virtually all the price gain from the upgrade came in the 7 months before it was upgraded. So that's just two strategies, you know, that I would give you, value/dividend strategies within the stock market, and an active, informed, high-yield strategy within the bond market.
So I guess this is a similar question, but let's say this new interest rate regime is a long-term, you're absolutely right. We've been in a multi-decade bull market, not only for equities, but also for fixed income. If growth is going to be harder to come by over the course of, let's just use the next decade, are there any themes that you see out there where investors who are, you know, younger, maybe have a longer time horizon, are going to be able to potentially accept more volatility in their portfolio, but reach for more growth? Anything thematically?
You know, I've done thematic. That was my niche besides being a quant guy, thematics. It's always the next technology, but we never know what it's going to be. I remember when Radio Shack was a growth stock. The problem is it's a very undiversified approach. So you're taking a lot of risk. So a diversified, good forward-looking tech strategy, but too often tech managers have to beat a tech index. And I think, as you know, tech is over concentrated in just four stocks today, right? Amazon, Google, Microsoft, and what
Apple.
used to be called Apple, plus what used to be called Google. I said it. Okay, Apple. So many tech managers, they don't want to underperform their benchmark, their index, and they don't take enough exposure there. So a truly active tech, by definition, tech strategy would be great. I don't know. Any of you guys remember the movie The Graduate? I don't know, Jordan. You could might be before you. 1968. You remember the one word of advice they gave Dustin Hoffman? Anybody?
You're gonna have to fill it in for me. That was not my wheelhouse.
Okay. I bet you most of your clients know it. Plastics. He's at the pool at a party and someone's, son, I want to give you one word advance. Plastics. Plastics was a great growth industry. So was aluminum. DuPont and Alcoa were growth stocks in the 1960s. It was a commodities industry by the 1980s. So forward-looking technology will always be an opportunity, but identifying the specific technology, we learned in 2000, it wasn't pets.com. And we learned recently, it's probably not AMC. So by definition, it's technology, but it's very difficult to identify, and it suffers from lack of diversification.
So when you look around the investing universe, whether we're talking institutional clients, individual retail investors, and in your conversations, I think it's pretty easy to pick out. I'm doing air quotes right now. You can't see the easy bets. Interest rates are going up. Inflation is higher than it was. Commodities prices are going up. Do you see any plagues across the board of investors, again, whether individual or retail, just being offsides, making too big of bets on this easy money that's to be made and may get a rude awakening when, for example, we just saw interest rates, the 10-year went from, it breached 2%, dropped right back down to 170 pretty quickly. Is there anything out there that you could see catching a lot of people over allocating to what they think is a sure thing?
Yeah, commodities going up is not a sure thing. The global economy is going to slow markedly by 2023 and possibly see recessions in some places, particularly Europe, at risk. Less demand. China's economy is near 2 to 4% growth, not 6 to 8. So less demand. So I'm not sure commodity is, everyone says, well, let's buy commodities. Inflation is high now. Yes, it's high now, but it's transitory. I think that's one of the more common errors today. I mean, inflation's not going back to 2% quickly. It's probably not going back to 2% within 3 to 5 years, but it's probably going back to 3 to 4%. Which means commodity prices are not rising. The higher inflation is going to come from service inflation because we've got these higher level of wages. As people go back into the workforce, they're going to be earning higher wages.
So for the last question I have for you, I want to leverage your decades of experience in all different types of markets. And it's going to be more philosophical than technical, so I'm hoping you're open to that. But we've got plenty of individual investors on the line. This will be replayed for anybody who wants to tune into it. What advice do you have for people right now, given kind of the news cycle that we're in, how easy it is to have access to the entire investment universe when that used to be kind of a beneficial barrier to entry for a lot of people? What do you say to the individual investor in times like these?
I guess maybe you hit on the news cycle. Would you stop it, please? Turn off CNBC. There is nothing that important. I remember when breaking news was breaking news. Walter Cronkite got on and we're going to hear something bad. Now breaking news is telling you what they told you for the last 3 hours. And then what do they have on CNBC at noon? They got these 4 guys talk I don't even know who they are or what they do, except they're good talkers. I mean, I haven't gone on CNBC in over 10 years. It's become let's be sensational, not informational. I think the best advice I could give you: turn off the TV, go for a walk, go for a bike ride, read a book, but nothing happens that's that urgent.
I love it. I mean, I think you hit the nail on the head. And we can wrap it there, but I hope that resonates with a lot of people. It definitely resonates with me. Ed Kerschner, Columbia Threadneedle. I want to thank you on behalf of our entire team, our client base, anybody who happens to tune into the replay, for taking the time and for giving us all the information and insight that you've accumulated over the years.
Stay safe and healthy, everybody. Have a great day.
Take care.